Welcome to The Explainer. Today, we're cracking open a financial product that you've probably heard of, LIC's new Jeevan Anand Plan. We're going to get into how it works, what really makes it different, and all the essential rules you need to know. You know, it's that age-old question when you're thinking about your money. Do I put it away for my own future, or do I use it to protect my family's future? Well, this plan is all about the idea that maybe, just maybe, you don't have to choose. It's designed to do both. So here's how we're going to break it all down today. First, we'll get into the core idea behind the plan. Then, we'll talk about the two main ways it pays out. After that, we'll look at how you can customize it, and we'll wrap up with the policy's user manual, the important stuff you need to know. All right, let's start at the beginning. What is this thing, really? What's the fundamental concept we're dealing with here? This is the best way to think about it. It's a hybrid. Part of it works like a savings plan, where you get a nice lump sum if you're still around at the end of the term. But, and this is the key part, it's also a life insurance policy that keeps that safety net active for your family for your entire life, even after you've already gotten that big payout. Now, you're going to see a couple of insurance terms thrown around, so let's just demystify them right now. PAR, which is short for participating, just means your policy gets to share in the insurance company's profits through things called bonuses. And non-linked means its growth isn't tied to the ups and downs of the stock market, which is meant to give you a more stable, predictable kind of return. So, if we boil it all down, these are the big selling points. You've got that mix of savings and protection. You get a lump sum at the end of the term, and that really unique feature, the life cover just keeps on going for the rest of your life. Plus, you've got options to add extra coverage or even take out a loan against it if you ever need the cash. Okay, let's get to the part everyone really wants to know about, the money. How and when does this policy actually pay you or your family? Well, it really comes down to two main events. So the whole payout system is built around these two scenarios. Super simple. If you live through the whole policy term, boom, you get the maturity benefit. If, on the other hand, a death occurs, your family, your nominee, gets the death benefit. But how that death benefit works is what really sets this plan apart. This right here, this is the secret sauce of the plan. Check this out. If death happens during the policy term, your nominee gets a payout called the sum assured on death, which is a higher amount, plus any bonuses you've built up. But here's the kicker. Even after you've survived the term and collected all your maturity money, that life cover doesn't stop. A second death benefit, equal to your original base amount, is still paid out to your family whenever you eventually pass away. Okay, so that's the standard package. But we all have different needs, right? So how can you actually tweak this plan to make it a better fit for your own life? Let's look at the customization options. You can think of these riders kind of like optional extras for a car. For a little more in your premium, you can bolt on extra layers of protection. You could add a benefit that pays more in case of an accident, or one that pays out if you're diagnosed with a serious illness. It's all about tailoring it to your specific worries. And you also get flexibility in how the money is received. Instead of just getting one giant check, you can choose to have either the maturity or death benefits paid out as a steady stream of income over 5, 10, or 15 years. You just have to make sure the payments meet these minimum amounts. All right, it's time to look at the nuts and bolts. Let's dig into the user manual for this policy, the practical rules you absolutely need to be aware of. So, what does a plan like this actually cost? This number here gives us a really solid, concrete example straight from the official illustrations. So what does that number mean? Well, that's the annual premium for a 30-year-old person who takes out a base plan of 200,000 rupees for a term of 35 years. It just gives you a real-world ballpark for what this kind of thing costs. What if you need some cash in a pinch? The policy actually has a built-in loan option. Once you've paid premiums for at least one full year, you can borrow against its value. And this chart tells you exactly how much, up to 75% of the policy's cash value if it's active and in force, or 65% if it's what's called a paid-up policy. But what if life happens and you miss some payments? Don't worry, it's not immediately game over. The policy actually gives you a 5-year window from your first missed payment to get it back on track. You'll just have to pay what you owe plus interest and maybe provide some proof that your health hasn't changed. And what if reviving the policy just isn't in the cards? Well, as long as you've paid for at least one full year, you've got a couple of options. The policy can become paid up, which means the coverage continues, but at a reduced level, and you stop earning bonuses. Or you can choose to surrender it completely and just walk away with its cash value. Now, this quote from the Indian Insurance Act is a huge deal, and it's a critical protection for you, the policyholder. It basically means that once your policy has been active for 3 years, the insurance company can't just turn around and reject a claim because of something you might have gotten wrong on your application, unless there was clear-cut fraud involved. So our goal today was really just to unpack the mechanics of this plan, to show you how it works, what it offers, and the rules of the road. Ultimately, the decision of whether something like this is right for you is always a personal one. The real key is understanding if this unique mix of savings and lifelong security actually fits into your financial picture.